from things that have come up during the week, and the webinar that I sat in on yesterday from your legal team at the NRA with Tenants. I think some things came out of that period where I wanted to address case studies, but more in a general way, and the key lessons we've learned from this experience. So we might jump straight into that, but I'll mention the webinar that was held yesterday by your legal team, Alex.
Yes.
Held that. I think that's worthwhile everyone here knowing about who wasn't in on that roundtable yesterday. That's to do with the interim authorisation the NRA received by the ACCC, which allows retail tenants who are members of the NRA to collaborate and essentially join forces and behave in a way which is otherwise unlawful to do by sharing information around their requirements for rent relief and collaborating as a group who can approach their landlord to seek certain conditions or agreements around their rent. If there is anyone here who would like to know more about that, I'd encourage you to contact the NRA legal team on the NRA inquiry number, and I'm sure they'll be happy to fill you in on that opportunity that retailers have under that authorisation. I think it possibly could add some strength to some negotiations for certain retailers particularly. And I know from the group yesterday there was almost universal agreement among them to share their details so that other retailers could contact them and potentially operate in that way. So that's I wanted to raise that because I don't think everyone knows of that opportunity.
Yeah, absolutely. And everybody, if you do wish to get into contact with the legal team, you can always forward questions to us at marketing@nra.net.au. And all those questions will be forwarded to the legal team for their appraisal. And also a reminder, everybody, Kyle will be answering questions in this webinar today, as he has always done in the previous ones. So feel free to pop them through in the Q&A box or the chat box down at the bottom of your screen. So Kyle, should we continue?
Yes, let's jump straight into it because I do want to leave plenty of time for questions. And like, as is the case every week, I've pretty much presented these slides just to raise key points and hopefully raise specific questions that we can deal with to provide more detail or more specific help and assistance to the people who are online and watching. So the first slide, Jess. What we're looking at is the 5 key learnings from case studies. So from specific examples that myself and my colleagues at LPC Cressa have dealt with over the past 12 weeks or so now, a little bit longer in fact. Things that we've seen and learnt from this, and I think would be worth sharing. Lesson 1, in an unprecedented situation like COVID-19 and this pandemic, and its impact on commercial tenancies and retail leases and so on, the divide and the competing interest between tenants and landlords has been laid bare despite both having a common goal. The common goal being continuity of business beyond and in the post-COVID era, seeing out your lease term, being able to meet your lease obligations, businesses continuing. Landlords are certainly concerned that their shopping centres are not full or not going to be full. Some shops haven't reopened. Some shops will close in the future as a result of this. The common goal is there, and yet the interests of the tenant versus the landlord are causing huge barriers to achieving that outcome. That's been a key lesson. We'll pop straight onto the second one, and I could talk about each one of these for the full half hour on their own, but I'm going to skip through so there's plenty of time for questions and discussion. Lesson 2, in most cases, the tenant has had to take the lead, provide the proposal to the landlord, clarify the process even, and the obligations of both parties, and drive the outcome. In very, very few cases have we seen the landlord taking that lead and being party to the mandatory code and achieving an outcome. As we've experienced through these 12 weeks of webinars, we've been finding our way through that to find the right processes and the right way to achieve the desired outcome. And for most tenants, it's been up to them to put that to the landlord and explain to the landlord what is fair and reasonable to ask for, and what rent relief they are seeking, and all of those things, which again, it's probably been a little disappointing that it's had to be driven by the tenant rather than in a more partner type way. But that's a key lesson, and certainly as per the topic of last week, it's time to close the deal. Essentially, the tenants really need now to put it in writing, put it to the landlord, explain to them what is required, and make it happen, and not wait for the landlord to do that. Lesson 3, I think, has been that the major impact is, or possibly is, over for most retailers, not all. But negotiations between tenants and landlords will continue for the next 12 to 18 months. We've got no doubt about that. There's a long recovery period ahead. Even where initial agreements have included a waived amount and a deferred amount, we absolutely believe that deferred amount may be negotiable later on. I wouldn't set that in stone. I have had conversations with at least one landlord who most definitely is taking that view that despite offering deferred rent now, they are prepared to negotiate on that down the track. I think tenants' actions during this process, the method of the negotiations, the behaviour of the tenant through the process, and all of those things will impact on how negotiable that deferred rent is in the post-COVID era, and whether it will ever really be required to be repaid or may be waived at a later point. Lesson 4 has been that even with a fairly prescriptive mandatory code, the outcome has been very difficult to achieve in many cases, and not just for retailers and small businesses, but certainly for tenant representatives and specialist leasing advisors. It has been a challenge to get the outcomes. The problem, LPC Cressa, for example, our key message to tenants is that we are the problem solver. You have a lease problem, a problem that needs overcoming, and we provide a solution to that. The problem in the initial instance was that COVID had impacted on business. What it actually became was that there were a lot of roadblocks to achieving an agreement with landlords, and we had to overcome that and find a solution to that problem rather than the bigger problem of the pandemic era. Lesson 5 is that just because you preface a sentence with acting in good faith doesn't mean you are. There's a key element in the mandatory code, if you read that requires that both parties act in good faith, and that's a particularly key element of the mandatory code. And over and over and over again, we've seen examples of people prefacing both verbally and in writing a sentence with acting in good faith, and then come out with something that is clearly not in good faith. So that's been a key learning, that your actions actually speak stronger than what you put down in writing. Good faith discussions have resulted in good outcomes during this process, and clearly where one or both parties are not acting in good faith, it's very difficult to get a good outcome that both parties are equally unhappy with. So that's been another key learning through this process. Up on to the next one, Jess, and I was just going to cover off some examples of the intent of the code being applied really well. And these are examples that we've experienced, one or two that we've experienced through other colleagues who have shared information. But there's a Queensland landlord who, in the first week of April, assured all 60 retail tenants that they would have rent-free until this is all over and you can trade normally again. And that's been adhered to by that tenant to date, which was a fantastic result. No requirement to literally show anything, but a clear understanding of the impact that would have on those tenants and on their assets in the longer term. So that was phenomenal. As a tenant representative, I would be very, very keen to place tenants in an asset owned by that landlord. That example is just one of many I have about that landlord, and you would strongly encourage tenants to lease space with them. Numerous landlords nationally who did apply the principles of the code and negotiated in good faith to provide reasonable and proportionate rent relief to a national brand who wasn't technically under the code due to having revenue above 50 million. So despite them not being eligible under the code technically, we've certainly experienced plenty of landlords who are still willing to apply the principles and the intent of the code and did provide rent relief proportional to impact on those stores, individual stores. I'm aware of a hotel chain who provided a client of mine with who leases space within one of the hotels, 50% waived rent for 3 months, very, very early in April, after our initial letter advising them of the potential impact and what we would be seeking. Immediately offered 50% waived rent for 3 months, without having to see any proof of impact or other documentation. And then a fast casual dining chain who wrote to landlords and advised them they were okay for the time being, but would like to keep in touch and if anything changed, then have conversations. So it just took a little pressure off the landlord who may have been expecting another tenant seeking rent relief and instead got notification that they were doing okay and they wouldn't be seeking rent relief, and could we just keep the lines of communication open in case that changes. It's a very good thing of that chain to do, and holds them in very good stead with their landlord, particularly if something does change over the next 3 months and then in a period after that. On the other side, some examples of where nobody wins. There's cases of landlords refusing to discuss rent relief until the code becomes legislation. That was a pretty common one we were experiencing there for a little period, which we did address here in this forum as well. Landlords reverting to their standard processes, requiring detailed financials, business and marketing plans, etc., whenever a tenant requests an abatement. Under normal circumstances, you can justify and understand why they would seek information like that to make a decision about providing abatements or rent relief to a sitting tenant. This situation was quite different. and yet landlords just reverted to their standard processes, which slowed up the whole process and caused lots of roadblocks. Landlords who have refused to provide rent relief, despite clear evidence of impact on the retail business, and where they've cited their own financial distress or own financial needs ahead of the tenant, and despite legislation and mandatory code, that's been quite disappointing and quite difficult to overcome. But that has been experienced on a number of occasions and does need to be overcome. And unfortunately, the only way really to address that, if they're ungiving in that respect, is to pursue the mediation process available. Landlords leveraging critical lease events to improve WALE and extend lease terms on current rents. So, one of the key KPIs, I guess, for a landlord and their retail assets is the weighted average of lease expiry. So it's a key determinant of how strong their asset is, and the valuation on that asset. And it seems that plenty of landlords have been shoring up their WALE, understanding that their asset valuation may take a hit during this or as a result of COVID. And it seems that plenty of landlords have used the negotiations around providing rent relief as a means of trying to improve that situation, and certainly to improve the prospect of having longer lease terms on the current rents rather than when a lease might expire in the next 12 months, it may be at a lower rent, as we've discussed here previously. And then the final one is on the tenant side. We've also unfortunately heard plenty of stories of tenants who have used COVID-19 to try to achieve savings despite little or no impact, and that's obviously causes landlords to suspect everyone rather than be more positive about the whole process. So, Jess, that's pretty much me in the first 15 minutes, raising lots and lots of points there. If we go to the next one, I'll talk quickly about next week because we've touched on it in that last couple of slides. Through the webinar yesterday and conversation with tenants over the past week, I think this is a really important aspect to the COVID negotiations that I do want to cover off next week. We had thought maybe this week would be the last one, but there's still so much information that tenants are seeking, understanding about things like this. So next week we're going to look at leveraging critical events. And a critical event in terms of leases is any event in the lease that provides an opportunity for one or both parties to change some aspect of it. So a market rent review, a lease renewal, an extension of the lease, any sort of critical event, annual rent increases, for example. So we're going to cover off next week in this format current tactics during COVID-19 negotiations by landlords and by tenants. What do you have to leverage and how can you use it? What are landlords leveraging? And looking at the short-term gains, which may actually result in long-term pain. So concepts that we have touched on and looked at before, but we'll look at it in specific light of what's happening right now with landlords, for example, asking for leases to be renewed before they agree to rent relief and extension of leases. And on the tenant side, there are plenty of retailers, particularly multi-site retail brands, who have leases in holdover and see that as potential leverage to encourage the landlord to provide better terms on rent relief. So that's next week. question and answer time. I've left up from last week just a couple of links if you'd like to follow LPC Cresser on LinkedIn or myself personally, or if you'd like to go to our webpage and have a look at the resource page, particularly where you can view these webinars and other webinars that we conduct with commercial clients, and provide numerous other updates on COVID and generally around commercial leasing and retail leasing. Any questions, Jess?
It seems to be silent at the moment, though I'm sure people are taking the time to type out questions. Everyone, please feel free to ask what's on your mind. I'm sure what you're thinking, everyone else probably is. It just takes one person to get the ball rolling. And I notice many of you are actually in our tenants, excuse me, our tenants roundtable yesterday. So if there's anything you'd like to continue on from, please feel free.
While people type that, one thing that came up yesterday, one of the questions yesterday, which was really good and very pertinent, was around a annual lease rent increase, which is within every lease. On your anniversary date, the rent will increase by CPI or by 3% or whatever. And whether that could be increased on July 1 when it falls. And the answer to that is most definitely no. The code prohibits the landlord from increasing the rent through any mechanism during the pandemic period. So, and also for the recovery period after, which is undefined, but that would be negotiable as to when the landlord actually increases your rent. So if you have an annual rent review, annual rent increase in your lease within the period from March 29 to September 27, please make sure that that increase isn't applied to your rental invoice in that month, and make sure that it's pushed back to beyond, and they can't recover the money that isn't invoiced during the period either. It only starts after that date. That also applies. We have a particular example right now where I'm negotiating COVID rent relief, but also a market rent review, which fell on a date, unfortunately, within the pandemic period, and the landlord is insistent on negotiating that market rent during this period. But I have pointed out to them that the outcome of that market rent review can't be implemented by them until after the pandemic period, even if we do go through the process now.
And Kyle, I remember, I think it was from last week's webinar as well, someone asked about landlords putting a clause into tenancy contracts about how relief won't be covered if there's a second wave of COVID. Do you have anything to elaborate on that?
Yeah, I thought that was really strange. There's no way I would allow that clause to be put in. Any second wave is still the pandemic period. If the government terms it, it's not a separate event. It's another part of this pandemic period. I would see it as. I'm sure that if that happens, it would probably happen within this 6-month period or within the reasonable recovery period after. It's not the end of this pandemic event. It's just another part of it. So there's no way I would agree to that. It's a landlord trying to indemnify themselves against that happening.
Yeah, it's it's a very scary thing to think about. So we have a question here from Teresa. Are you seeing any trends in lease renewal negotiations going forward? Annual increases in my example have been at a firm 5% in our lease, and this has been non-negotiable. The compounding effect of this makes the lease cost extremely high at the end of the lease term. And then they want to seek a rent increase at renewal once again.
Yeah, of course. That's an ongoing issue over the past 7 or 8 years or so. Last 5 years particularly, where it's those annual increases have jumped from what used to be pretty standard 3% or CPI to 5% increases, or CPI plus 2.5% if you're in a major shopping centre. We are seeing leases being renewed at much lower than that, with CPI expected to be a negative in this next quarter, the current quarter. Essentially, if you're in a big shopping centre, your increase will be roughly 2.5%, and that's allowing us certainly to negotiate rent or new leases and lease renewals as a lower percentage, and aiming at 2.5% and 3% levels instead of 5%.
Okay, so the 2.5% to 3% increase is the trend rather than a 5% increase.
Certainly.
Okay.
Yeah, and achievable. If you agree to anything over 4%, you're not helping your cause over the next lease cycle.
Okay, Teresa, if you wish for Kyle to elaborate on this question, please email us at marketing@nra.net.au and we will forward this on to him and he can go into more detail with you, because it seems like a case that needs to be gone into more detail there. If there are no other questions here, of which I'm not seeing any other questions popping up, Kyle, would you like to wrap it up here?
Yeah, that's fantastic. I'm glad there's no questions. It means everyone must be on track to get their agreements signed off and agreed to. Hopefully we've provided lots of good information that helps you to consider some things that may not have been considered, and some examples of good outcomes that you can call on as well. Look forward to doing next week's and addressing some leveraging options. And as always, if there are topical things that we can address for you, please send them through to Jess's team in the marketing department, and that will get to us.
Oh, we have one straggler question at the end here from Anonymous. CPI increases, why do they differ from contract to contract?
I'm not sure what that means, CPI differing.
So if in Teresa's example, the trend is 2.5 to 3% increase, but Teresa's example is 5%, why would different landlords have different CPI increases?
Okay, well, so just to clarify, it's not a CPI increase. A CPI is a rate. It's either a CPI increase or a fixed rate increase. So why it differs between landlords who are seeking a certain return on their investment, and their investment strategy and financial strategy and so on determines that they are seeking a particular return for their investment, for their shareholders and so on. And clearly some brands or some owners are trying to achieve a certain percentage return to shareholders and so on, like a annual 6% growth on revenues and things like that. So it's their mechanism to increase their revenue year on year. It's as simple as that. And it's the tenant's job to make sure that it's in line with their retail growth and the opportunities that that landlord provides through the leased premises to achieve those revenue objectives. So where there's a mismatch, and clearly in the next lease cycle there is a mismatch between those sorts of returns versus what the asset that you're leasing will provide your business with. Retail returns in the next lease cycle are expected to be softer, harder to get year-on-year growth in top line and also in profit. So if you just look at a simple chart and your retail sales are growing, as they have for the last couple of years, at an average of 1.6, 1.8, some really good categories growing at 3.6%, but your annual increase in rent is 5%, then you can see that your bottom line is going backwards. So the idea is to match those up and the argument is on the return that you receive compared to the return they're receiving, and sharing that burden.
Okay, hopefully that answers your question, Anonymous, as to why some CPI or increased rates differ from landlord to landlord. We have a lovely note here from Teresa saying, I'm looking forward to next week's webinar. It looks like a lot of good topics.
They will continue as long as people require information to get through this process, and then hopefully even after that we can continue with some really good retail leasing basics on a monthly basis or something like that.
Very much so. Okay, everybody, thank you for your time and for joining us today. Kyle, thank you for taking time out of your very busy schedule. I know LPC Cressa is helping a lot of tenants at the moment.
We are.
And everybody, stay tuned for next week's webinar. You'll receive a reminder invitation at the beginning of next week. Thank you all for joining us, and we'll see you next time.
Thanks, Jess. Cheers, everyone.